All right, well, good afternoon, everybody. So yes, my name is Deyeon Kim. I'm the growth lead at Potts Finance. So today, I'm going to be presenting on DAOs and the art of risk mitigation, the importance of hedging, okay? So just a little background about me. I've spent about 17 years in TradFi, from institutional sales trading to private wealth management at JP Morgan, which is the largest bank in the United States. Back in 2013, I bought Bitcoin for under $300 per token. At that time, all my colleagues made fun of me. They said I threw money away. My mother was crying, like, oh, I raised the degen. And now fast forward a few years, and all my colleagues are asking me, oh, when do I buy Bitcoin? When do I buy Ethereum? And now my mother says that she raised a good man. So who's laughing now, right? So that is... Yes, that's my background there. So today, my presentation is really about treasury management challenges, what is hedging, why hedge, how do we hedge, and some hypothetical scenarios and best practices. So what is a DAO? For those that don't know, a DAO is a decentralized autonomous organization. There's a lot of them. You have ones like Optimism and BitDAO that have billions of dollars in their treasury, and then you have some that don't even have $1 million in them. And you see weaker DAOs fail every day, and you see new DAOs get formed almost every day as well too. One of the benefits that DAOs have is the inclusivity of their membership. All you have to do is own one of their governance tokens that they issue, or an NFT, and then you are a DAO member. So potentially they could have a global reach in their membership. But as organizations, are they always organized? That inclusivity is actually partially the source of some of their problems. So one of the problems that is often the case, we talk to a lot of DAOs at Pods. I've conducted lots of treasury interviews with treasury heads. So oftentimes there's no designated, well-defined treasury team, especially amongst the smaller DAOs. It's usually just like a volunteer or somebody who's deemed to be trustworthy. And usually they do not have professional financial management experience. And also, too, you have key people that can change often. They have voting every 3 to 6 months where leadership and treasury members can get replaced. So sometimes there is a big challenge in planning these longer-term initiatives, especially when you have new leadership changes every 3 to 6 months. And so that's why the finances can be actually quite difficult. Also, too, even if they do have financial initiatives that they do want to pass, oftentimes, especially in the newer DAOs, you see a concentration of votes around whales. So if some of these whales are not on board, or if they're AFK, away from their keyboard, and are non-responsive, you may not be able to reach a quorum in order to get any initiatives passed. Financial challenges. So a lot of these DAO treasuries, a big percentage of their treasuries are in their own native tokens or their NFTs. And there is a deep hesitancy within DAO members to vote for selling this native token, right? As a DAO member, if you're holding all these native tokens, it's very unlikely that you're going to vote for the treasury to sell that and put selling pressure and downward pricing pressure on the token that you're holding. And some DAOs have some provisions where, without a vote, they can sell some parts of their native token to raise additional funds. But still, even though it's allowed to do that, there's this optics and politics around that, because if they do sell within their mandate and they are blamed for the downward price in their native token because of a selling pressure, they can get easily replaced in the next 3 to 6 months in the vote. So there's a lot of politics involved in DAOs, and sometimes the assets may not even be liquid. They may not be able to sell. And then obviously there's price volatility as well. We all know crypto can be extremely volatile. These native tokens and NFTs oftentimes have way more volatility than Ethereum or Bitcoin. So, and when Ethereum or Bitcoin is going down 10, 20%, these native tokens are going down 30, 40%. And some native tokens actually haven't even started their rally yet. So, ETH and Bitcoin, they bottomed out in Q3 of 2022. Some of these governance tokens and NFTs, they're still going down since then. So oftentimes they have a leveraged downward price capture, but then sometimes none of the upward capture, which also poses its own set of challenges. So these are actual real DAO scenarios. The only thing that I cut out are the name of the DAOs, because I just didn't want to put anybody on blast. But you can go to deepdao.io, and you can actually take a look at all the treasuries. And these are, just take a look at any one of them. Most of them look like this. In 2022, a lot of these DAOs lost 80 to 90% of their treasury value. There are very few that maintained their treasury values. Usually it's because they were always in stable coins. But most have a governance token or an NFT or an ETH. And if that's the case, their treasuries kind of look like this, all right? So this is a hypothetical DAO treasury scenario. So in this scenario, I have a DAO, with $100 million, just to make the math easy. And then I put the monthly Ethereum performance, and then we have each column represents the number of years in the runway, or how much they can spend without, without going to zero. And so in the 5-year, for example, this means that they're spending about 1.5% of their treasury on a monthly basis. On this side here, 1 year, they're spending about 8% of their treasury on a monthly basis. And as you can see too, as their treasury value goes down, that nominal value of that cash burn per month also goes down. So for some of these DAOs, if they had kept their costs fixed in 2022, and if they had less than 4 years of runway, they wouldn't have made it. They would have been at zero. So in 2022, we actually saw that. We actually see a lot of these walking wounded DAOs. Basically, they're still open and they're still members, but they can't do anything because they don't have any funds. And so a lot of these DAOs did a lot of cost cutting. So this kind of, it gives that a fair representation of that spending. Okay? So hedging. What is hedging? Hedging is taking an offsetting position to protect against price risk in another position. So a hedge is very comparable to insurance. Let's just go over an example here. Let's say you buy a house, all right? You want to protect it from bad weather disasters. So you buy flood insurance, let's say. If there is no flood, well, you have to still pay for that flood insurance, right? And so it eats away at the return of your house. However, if there is a huge flood and your house just gets wiped out and, in a mudslide or whatever, and there's flooding, then your insurance policy will pay out and you get to recoup some of that value that you put into your house. So there is a risk-reward trade-off in hedging. It reduces risk, but also reduces your potential rewards, especially in prolonged bull markets. There are instances where hedging will actually get you ahead rather than going just straight into an asset, and that's what we call like a choppy market. We call that a price discovery market, where it has big upswings and downswings, but then in this period of time, it stays relatively flat. So in that one instance, hedging will actually put you ahead. But in these prolonged bull markets, yes, there is definitely a risk-reward trade-off in hedging. All right, so how can we hedge? There's many ways to hedge. These are the three most popular ways of hedging that I heard of when I spoke to the treasury heads. There's some DAO treasuries that actually do have legal entities. And so there's some of them that mentioned expressed interest in getting some CME futures, the Chicago Mercantile Exchange futures. You see the S&P 500 futures on there, oil, gold, silver, commodities. They're all traded on the CME, and also Bitcoin and Ethereum. But again, you have to have a legal entity. You got to go through KYC, AML. And usually, though, the participants in the Bitcoin and Ethereum CME futures are TradFi institutions. Most of them were trading S&P 500, crude oil, gold, and silver, like all these other CME futures before they started trading Bitcoin and Ethereum futures. So it's mostly favored by TradFi institutions. There's also perpetual futures too, and like the CME futures, it uses leverage. So you could potentially be forced liquidated, or it could be extremely costly if that hedge goes against you. And actually, I have one example here. This is a Friday to a Friday in Ethereum, okay? 1 week, all right? So let's say at the end of day Friday, right here on that first vertical black line right there, you decide, hey, you know what, by next week, I think Ethereum's gonna be down by next Friday. Well, you were right, but on Friday night to Saturday, you saw a 180-point rise in Ethereum before it started falling. So depending on how much leverage you're employing, that could have been your liquidation event right there. You could have been forced liquidated, or if you actually exercise some good risk management, you might have gotten stopped out, okay? Even though you were right for that week, your timing has to be impeccable if you're using that leverage. So another way that you could hedge is with the options market. Now the challenge with options, and the reason why most people are turned off by options, is because you got to be right in 3 aspects for a payout. You got to be right on direction, timing, and the volatility expectation. Okay, most people are thinking, when you buy a put option, which is a bearish bet on the market, hey, the market went down, but I still didn't get my payout. Well, maybe it's because your timing was off. Maybe it expired before the actual price movement went in your favor, or maybe the volatility expectation was wrong. All right, so you have to be right in those 3 aspects. However, there is a benefit to using options, which is buying options is a defined risk position, okay? Defined risk. What does defined risk mean? It means that you know what your worst outcome is going to be on that trade. The worst thing that can happen when you buy options is that your options go worthless. It goes to 0, right? So it's defined risk. It can also be very capital efficient because it has a convex return profile. What does convex return profile mean? So it's this curved line right here, that parabolic curved line, all right? Convex return means as the position goes in your favor, your profit grows exponentially on that trade. All right, and that is how we can have capital efficiency. You just don't need as much to get a large payout on a very large move in the market. All right, and as you can see, I have a little red line right here. That's your cost. That's your defined risk right there. You know the worst outcome is that cost, and even though it keeps going against you, that's still the worst outcome that can happen. Okay, and then obviously, as price goes more and more in your favor, you start getting that exponential payoff. We call this like a gamma explosion in options trading. All right, this straight slanted line, that's more of a return profile for holding an asset, or maybe perhaps holding a futures contract or a perpetual futures position. The slope of this line is dependent, is based on how much leverage you're employing. So the more leverage you're employing, the more the slope of this line is going to be vertical, all right? The less leverage you're using, it's going to become more horizontal, all right? So here is the unhedged hypothetical treasury scenario. I just showed you this from before. The only difference is now I put some colorful circles down there so you can now track what it would look like in April, which is this month. So these all have been updated. So this is what it looks like when you are unhedged. Now, the benefits of hedging. Let's say you take 20% of your treasury portfolio, all right, and you put it into, let's say, a stable coin, USDC. All right, you take that USDC, you put it into Aave. Right now, Aave is yielding around 2.7%. You take that 2.7% on a weekly basis. It's 2.7% annualized, and they pay you, little bits on a weekly basis. You take that weekly yield, and you buy out the money puts, which are bearish bets on the market with that yield. Okay. This is the results you get. So if you had a 5-year runway, if you spent less, if you were spending less, if you were only spending 1.5% of your treasury every month, you would have around $70 million left over after April. In the previous example, you had about 45 million. So you have a good 20 million extra. Your opportunity cost for not hedging costs you about $20 million. Now, if you had less of a runway, if you were spending more, if you had 2 years or 1 year, and most DAOs that we talk to are in this camp right here. They have 1 to 2 years of runway. You would have about 56 million or about $41 million if you had hedged with 20% of that portfolio. Without it, 30 million and 15 million, okay? So for those, especially in the 1 year segment, we're at 15 million. That is about a $25 million difference, so more than double, okay? Almost triple, right? So that's a huge opportunity cost. And one thing I want you to notice too here is that you see that with the hedging performance, since you're only using the yield portion, when the market is going up, you're not really losing all that much, but it doesn't really pay out unless there's a quick movement. Basically, this will pay out when you need it the most, all right? That's usually how hedging with options works. And as you can see here, we have a risk event that happened in May, June. Does anybody remember what happened in May, June of 2022? Anybody remember? 3AC, all the systemic risk. One firm borrows money, lends money to another firm, and that firm lends money to another firm. One firm fails, and then all of a sudden, all these firms can't meet their obligations. And remember, we had a huge sell-off in the market then. We had a 30% down in 1 month and another 45% in the next. Also, too, this strategy paid out in November and December as well. November in 2022 as well. Does anybody remember what happened in November of 2022? FTX, that's right, FTX, right? So when FTX failed, there was a huge sell-off in the market, and boom, this strategy would have paid out. So let's talk about a little bit more. What if we hedged with 40% of the portfolio? All right, now some of you may be asking, maybe telling yourself, well, gee, 40% of the portfolio to hedge, that seems like a little bit too much to use for hedging. Well, in traditional finance, when we did asset management for a lot of foundations and for high net worth individuals, we called the 60-40 portfolio a balanced portfolio. Basically 60% in risk assets like stocks or other risk assets, and then 40% in short-term treasury bonds, cash equivalents, things of that nature. So in traditional finance and professional money management, 40% of a portfolio being used as hedging or something to counteract a risk asset is actually not so far-fetched. And again, in this example, we would have had, if you had a 5-year runway, you'd be left with about $90 million in your treasury, whereas unhedged, again, about $45 million. And then also, if we go here, on this side, if you had a 1 year or 2 year, if you had 1 year or 2 year in your runway, you'd be left with 64 or $78 million after hedging. But if you didn't hedge, again, 30 or 15 million. That's a huge opportunity cost. Imagine you are the head of a treasury, you did not hedge, and now your $100 million treasury is now at $15 million. But if you hedged, it could be at $64 million. So somebody needs to answer some questions about $50 million that is missing, right? That is a very uncomfortable conversation to have to your DAO members, all right? So the key takeaways here is that hedging is beneficial in preserving the value of a portfolio or treasury, especially if you have less of a runway in your DAO. And also it makes potentially larger losses into smaller ones. One thing I also want to point out too is in the unhedged one, I don't know if you can see because of this table right here, but right here, as you can see, from January till now, we've had an actually decent rally in crypto, right? We've had a decent rally. But here, if you were unhedged, you started at the end of December, you had about $14 million, but now you only have about 15 million even after this large rally. Why is that? Well, who here knows Warren Buffett and Warren Buffett's rule to investing? Anybody? What's rule number 1? Don't lose money. That's rule number 1, is don't lose money. What's rule number 2 that Warren Buffett says? Always remember rule number 1. There's a reason for that. It's basic math. If you lose 10%, you need to make 11% to break even. If you lose 50% of your portfolio, you need to double your portfolio to break even. If you lose 75% of your portfolio, you need to quadruple your portfolio to break even, all right? You basically, when you take these large losses, you dig yourself in a hole, and it takes all this time and effort to dig yourself out of it. You have to keep your losses small so that you can recoup quickly and then start making new money again, all right? So again, benefit of hedging, you do not take those large losses, all right? And then options provide a convex return profile with defined risk. So that is why, especially with me and those in TradFi, also at Pods, we prefer an option strategy in order to use that for that convex return profile and defined risk, all right? Now, anybody have any questions, comments, rude remarks? I know I put a lot of numbers up on the chart. A lot of people have stuff to say whenever I do that. If you have any feedback or questions or comments you would like to share with me, I'd be more than happy to answer you guys online as well. If you take a picture of this QR code, it links to Pods, it links to my personal Twitter and Telegram and my email as well, and I'm open to answering questions or having a discussion with you online about this anytime. Thank you.
Okay, questions?
Hey. So I think a question that I have is a big problem with obviously hedging on chain purely is you expose yourself to a bit of smart contract risk when you're doing that, and that's something when I've spoken to DAOs before about this problem they are typically uncomfortable with. So I remember even when we were at risk planning on allocating our treasury to something, we were saying, oh, why don't we deposit in Euler? And if we had done that, we'd have lost our treasury. So I think that may be something that is sort of mispriced a lot when you're thinking about these hedging strategies, and I'm wondering sort of what your thoughts are on that tail risk.
So yeah, for tail risk and definitely, if something happens to a smart contract, it's not going to provide. You might end up losing everything, right? And so that is a very interesting problem. I don't know if there is an answer to that, right? If you look at any type of on-chain solution, you're always going to have that smart contract risk. So I think to hedge or to protect yourself from that tail risk, we probably need to look at some security solutions or things of that nature. Like in that home insurance example, you're buying home insurance, to protect yourself from your home getting flooded, right? Perhaps what we also need is some type of smart contract insurance. And perhaps that might be a way to hedge against that or from an attack or of that nature.
Yeah, I think that'd be quite an interesting stat to add to this model you made. It'd be quite cool.
Sure thing, yeah. Thanks for the feedback, thank you.
I have a quick question. I feel like a lot of times in DeFi, you don't really have hedging options. Like I would like to hedge a lot of the things that I'm exposed to, but either the options or volatility is too expensive, or there's not enough liquidity to get out of a position. Let's say you're a DAO and your treasury is primarily in your own token, and there's no actual liquidity to move it into stable coins. So in these kinds of situations, what do you think is the best thing that a project can do to hedge to the best of their ability given the market conditions?
Yeah, so I didn't want to really bring this up. I wanted to make this as educational as possible, but I am at Pods, and so since you asked, we do have some products that we are about to launch where you can get a hedging structure, payout structure with a vault. Actually, this strategy that I just described to you is going to get launched pretty soon at Pods. And so this is something that we developed after having a conversation with multiple DAOs. Just like what you said, they said exactly the same thing. We would like to hedge for the next bear market. We just don't know how. So stay tuned, and pretty soon we're going to have something for you guys.
Great, thank you.
Hi, great talk. I have a question. If many DAOs are piling into these kinds of hedging strategies, does that not dilute or does it not make it more expensive for any tail DAOs coming in? Like, the first one is obviously going to get better pricing on the hedging options that they buy, but anyone coming after it'll slowly degrade. Is that true?
No, that's necessarily true because we're also, at least in the example that and the back test that I did, we used weekly options. So every week, it's an option that expires 1 week later, and then you take the next week's yield and you buy the next week's options with it, okay? So we're using 1 week, weekly options to do this. So it's not like we're buying something like, a year out or something like that, and then, everybody that's coming afterwards piling on, it gets more and more expensive. It's not like that. The scenario that I ran was for weekly options.
Okay, thank you.
Okay.
Let's maybe take one last question.
What do you think about protocol-owned liquidity to diversify the treasury out of its own native token?
Providing liquidity to do so?
To diversify the treasury out of its own native token using protocol-owned liquidity?
We actually find that a lot of DAOs do not want to do that. They don't want to take that chance of impermanent loss. And so, yes, diversification is also key. But again, from what I presented about DAOs, a lot of these DAOs have about 50 or 60, even higher percentage of their treasury in their native tokens. And the optics around selling that, it's just, it just won't pass the initiatives. And if they even do a little bit that's within their mandate, they might get voted out. So they have limited capital to use for this. And they would rather have direct, what we call negative delta exposure. As the market drops, this has a positive payout. They want something like that because they want it to be capital efficient, because they just don't have that much capital to allocate toward a hedging portfolio, because most of their portfolio is in stable coins and in their own NFTs.
Okay, let's round of applause again for Deyeon.